Welcome everyone to Steve Savant's Money, the name of the game. I'm your host, Steve Savant, syndicated financial columnist and money-colored commentator. On today's show, qualifying for a mortgage, I might want to add, and what mortgage should I pick? Part 5 of our series on America's real estate investment with real estate expert Mike Bodine. Well, Mike, we've talked about a lot of things this week, every segment, qualifying for a mortgage, but boy, should I do a 30? I've heard there are 40 years out there. 40 years. In Japan, a lot of households stay that's transferred from one generation to the next. There's a 100-year mortgage over there. So, it's bizarre. When we got into the hot selling crazy times of the mid-2000s, people were just paying interest. So let's walk through, what do you see today? What is today? Is 30 years still the rule of thumb to begin with?
It is.
It is.
It is still the rule of thumb. 15-year is optimal for people that want to start, paying down the mortgage amount there.
Yeah, what's the impetus of a person wanting to pay down and going to a 15-year platform?
Well, that's a philosophy.
Oh, it's okay.
It's a philosophy. Some people, like you mentioned, Dave Ramsey there, feel like, no debt is good debt. So it's good to get that paid down. And quite honestly, when you think about it, especially, when maybe there's not a lot of good solid investments out there where you can be sure, if you have a 4% mortgage and you're paying that down, isn't that kind of like a 4% investment? Aren't you really kind of getting like 4% on your money?
Yeah, people look at their home as an appreciating value. It hits their net worth statement. Remember, we're going to see assets versus liabilities. So there's going to be some movement there. So I think that's true. And let's go to that 15. I noticed that the temptation, if you go out to bankrate.com or any of these guys, you see the 15-year and you're going, wow, that's 35, 40 basis points less than the 30-year rate. But when you're down this low, is 30 basis points really that much of a difference?
Over 15 years, it is.
Oh, it is.
Big time.
So you have to say to yourself, do you got the cash flow? Now, are the lenders going to make sure that you actually do have the money to pay for a 15?
Sure. They're going to qualify you at 15 year, just like a 30.
Okay. Now, Mike, I brought this up at the front end of the segment. There's 40-year out there. Do you see many people pulling that right now?
No, none.
None. So that kind of had its time. I thought it came up in the late 2000s. Kind of now not there.
We haven't seen it, no.
Yeah, so it's pretty much gone. Okay. Now.
That's almost interest only.
It is. It really is.
And why wouldn't somebody go to a interest only ARM?
Right.
If they're going to do that.
Well, let's talk about ARMs. What are they on now? There's 10, there's 7, I think there's 5.
5.
Is there a 3?
There is a 3.
There's a 3.
Yep.
Why would I do that? And what is the spread on the interest?
Yep.
And by the way, what's the danger if I can't reconcile at the end of that short period in time as the homeowner?
That's a great question. Well, first of all, the shorter in term you go from a 30 to a 15, you're going to get about 0.5%.
Wow, so it's worth it. Look
you go from 15 to a 7. You're going to probably drop another 0.25% from there. You go from 7 to a 3, you might drop 1/8 from that point. So you're dropping interest. You're dropping in years. You're dropping an interest rate there. So there's also an interest rate savings.
So have you seen, and the people that are doing short, because 15 sounds short to most Americans, but now we're talking 10, 7, 5, 3-year ARMs.
Yep.
So what is the you're going to do a short period in time, what's happening in the market right now? What have you seen?
Well, right now things seem to have normalized. So that's why the 30-year, we don't even see hardly any 15 years. People are more kind of still jumping on the 30-year bandwagon there. It seems to make sense for most people.
Okay, so you don't see too many ARMs lately, right? Is that what you're saying?
No, and what I explain to my clients, if they're considering that, especially if they're looking at, like a 5-year call date. In fact, I have one client and friend right now, 10 years ago, at the height of the market, he bought his home. And at the time, he got into a very sweet mortgage. I think it was like 3.5%. And he did, and it was 2 loans. So he had a first and he had a second that was interest only. And the combined mortgage payment on that was $2,200 a month. And this was like $650,000. Well, it was a 10-year call date on these loans. Well, he wasn't expecting to be able to hold the house. He had never held a house that long. He held this one that long, and he had a LIBOR rate. The LIBOR rate jumped up, and it went from interest only at the time to now to the current rate. So he's seen his mortgage go from $2,200 a month to $3,900 per month.
At the end of his 10-year arm.
Which is now.
So you have to really understand there is possible problems with this, right? I mean, you just have to be fully disclosed. What is the worst scenario? Well, we couldn't sell the house. We couldn't, we might have to go past our 5-year, 7-year, or 10-year arm.
And we went through the worst case scenario 10 years ago.
And to him, I'm sure it seemed improbable.
Well,
I mean, absolutely improbable.
Exactly.
Yeah. All right. So I'm looking at a mortgage. I did my pre-qualification. It depends upon my rating, my FICO scores, all these other things. I've looked at my mortgage and I've chosen let's just go traditional first. I'm on the 30-year platform and I'm just going to shop. Now, when you're a real estate agent, you know the players out there. Are there really much difference between regular mortgage brokers that are not in a bank, so to speak? They're just they're kind of like a front for many institutions. Or is the conventional, like a Chase, like a Wells Fargo, is there more differences between the rate you're going to pay on a 30-year?
Oh, you really want to get me in trouble on this one here.
Well, here, let me just say, we're talking to consumers and they want to know, and you're the expert. So, and remember, we're not casting any negative aspersions on any of the institutions. We're just saying there are differences. Are there really differences in the price you're going to pay on the interest rate?
Well,
closing costs,
there are. Although now, and I will say, again, another benefit to Dodd-Frank, in the matter of disclosure brought about now, how much money the bank is actually making on this. Before Dodd-Frank, there was, for example, let's just say that the rate, the standard 30-year rate was 4%. But I had a client who actually could come in at 4.5%. I, as the mortgage broker, will make thousands of dollars because I'm delivering this client to the lender at an above market rate. So they're going to pay us more money. That was a horrific practice. So we're glad to see stuff like that no longer a part of the market, because that was illegal.
So that's been eliminated because of Dodd-Frank. So there's a good regulation that was positive for the consumer.
Correct.
Okay. All right. Now, I'm looking, is there a difference between conventional, FHA, VA? I mean, are there interest rate differences if I'm on a 30-year platform? I mean, if I'm a vet of the United States military, should I be looking at the VA?
Absolutely. The VA is a great loan. I mean, first of all, it is 0% down, and the rates are very comparable, and you're not paying mortgage insurance.
Wow. So that's a huge thing for military.
Yes.
If you've done service, thank you for your service. This is a huge way to go. What about FHA?
Well, FHA, again, the benefit of FHA is at least twofold. Number one, it is a low down payment. Number two, it's also, they're a little more liberal in their qualifications. So somebody that couldn't get a conventional loan could very well qualify for an FHA loan. So, and that's a big deal. You may be really close, but you just can't get that conventional loan. FHA will qualify you. Okay,
so VA, FHA, conventional loan. That tells me that all 30-year mortgages are not created equal, whether it's the down payment we're talking about or maybe even the rate.
Yes.
Well, listen, I want to thank Mike for sharing this series on America's real estate investment. And keep in mind, before moving forward with any of the ideas you've heard all this week, always check with your tax consultant, legal counsel, financial advisors, and a good professional real estate agent. I'm Steve Savant. You've been listening to Steve Savant's Money, the name of the game.